What are financial products? Simply put, financial instruments are tradable assets. Examples include cash, precious metals, documents confirming ownership of something, and the right to deliver or receive cash. Financial instruments can be very complex, but the basic idea is that you can trade whatever the financial instrument represents and what it represents. There are different types of financial products based on different classification methods. One of the classifications is based on whether they are financial or derivative products. As the name implies, derivative products derive their value from something else. Financial instruments can also be categorized as debt-based or equity-based. But where does cryptocurrency fall? They can be thought of in different ways and can fit into multiple categories. The simplest classification is that they are digital assets. However, the potential of cryptocurrencies lies in building a whole new financial and economic system. In this sense, cryptocurrencies make up a completely new category of digital assets. Moreover, as ecosystems evolve, many new categories can be established that are not possible otherwise. This first example is already seen in the field of decentralized finance. What is the spot market? In the cash market, financial instruments are traded for so-called immediate delivery. Delivery in this context simply means exchanging financial instruments for cash. This may seem like an unnecessary distinction, but some markets aren't settled in cash right away. For example, when talking about the futures market, the assets are delivered at a later date. Simply put, a spot market can be thought of as a place where transactions take place on the fly. The current market price of an asset is often referred to as the spot price because the transaction is settled immediately. So, what does this mean in the context of the crypto market? What can you do at Binance's spot market? You can exchange coins. Therefore, if you want to exchange BNB for BUSD, please visit the BNB BUSD spot market and run the boiler. If you want to exchange BNB for BTC, please access the BNB BTC spot market in the same way. Coins will be exchanged as soon as your order is completed. This is one of the easiest ways to trade cryptocurrencies. What is margin trading? Margin trading is a method of trading with funds borrowed from a third party. In fact, margin trading amplifies the results both good and bad. Margin accounts provide traders with more access to capital and eliminate some counterparty risk. Why? Well, traders can trade the same position size but hold less capital on the crypto exchange. When it comes to margin trading, we often hear the terms margin and leverage. Margin is the amount of capital you hold. Leverage is the amount that increases the margin. Therefore, when using double leverage, it means opening a position that is twice the margin. If you use 4x leverage, open a position equal to 4x the margin. However, please be careful about clearing. The higher the leverage, the closer the clearing price will be to the entry. If you get liquidated, you'll risk losing your entire margin. So, be very aware of the high risks of trading on margin before getting started. The Binance Margin Trading Guide is an essential resource before you get started. Margin trading is widely used in stock, commodity, and forex trading, as well as the Bitcoin and cryptocurrency markets. In a more traditional setting, the funds borrowed are provided by an investment broker. In cryptocurrencies, funds are usually lent out in exchange for funding fees. However, in other cases, the borrowed funds may be raised directly from other traders on the platform. Interest rates are determined by the open market, which usually results in a floating interest rate. So I briefly explained what margin trading is, but there is still something to be learned. If you would like to read more details, please read what is margin trading, what is the derivatives market. Derivatives are financial assets that base their value on something else. This can be an underlying asset or basket of assets. The most common types are stocks, bonds, commodities, market indexes, or cryptocurrencies. The derivative product itself is essentially a contract between multiple parties. Get the price from the underlying asset used as a benchmark. Regardless of which asset you use as a reference point, the core concept is that the derivative product derives its value from that asset. Common examples of derivative products are futures contracts, options contracts, and swaps. Derivatives markets are one of the largest markets out there, according to some estimates. Why? Well, derivatives can be present in virtually any financial instrument, and so are derivatives themselves. Yes, Derivatives can be created from derivatives, and you can create derivatives from those derivatives and so on. Does it sound like a nasty house on a card that is about to collapse? Well, it may not be too far from the truth. Some argue that the derivatives market played a major role in the 2008 financial crisis. What are futures and futures contracts? Futures contracts are a type of derivative product that allows traders to infer future prices for their assets. This is an agreement between the parties to settle a transaction at a later date called the expiration date. As discussed with derivatives, the underlying asset of such a contract can be any asset. Common examples are cryptocurrencies, commodities, stocks, and bonds. The expiration date of a futures contract is the last day that the trading activity of that particular contract continues. At the end of the day, the contract expires at the last traded price. The performance of the contract is predetermined and what are perpetual futures contracts? Futures products are a great way for traders to speculate on the price of an asset. However, what if they want to remain in their position even after the expiry date? Enter perpetual futures contracts. The main difference between them and a regular futures contract is that they never expire. This allows traders to infer the price of the underlying asset without worrying about maturity, but this causes problems in itself. What if the price of a permanent futures contract is really far from the price of the underlying asset with no expiration date? The permanent futures market can show a serious and ongoing discrepancy with the spot market. For this reason, perpetual futures contracts introduce a funding fee paid between traders. Imagine that the permanent futures market is trading higher than the spot market. In this case, the funding rate is positive. That is, the long position pays the short position funding fee. This encourages buyers to sell, lowering the price of the contract and approaching the spot price. Conversely, if the permanent futures market is trading lower than the spot market, the funding rate will be negative. This time, shorts pay long and give incentives to raise the price of the contract. To summarize, if funding is positive, longs pay shorts. If funding is negative, shorts pay longs. Perpetual futures contracts are hugely popular among Bitcoin and cryptocurrency traders. If you'd like to read more about perpetual futures contracts, check out what are perpetual futures contracts. What are options contracts? An options contract is a type of derivatives product that gives traders the right, but not the obligation, to buy or sell an asset in the future at a specific price. The main difference between a futures contract and an options contract is that traders are not obligated to settle options contracts. When traders buy an options contract, they speculate on the price going in a direction. There are two types of options contracts: call options and put options. A call option bets on the price going up, while a put option bets on the price going down. As with other derivatives products, options contracts can be based on a wide variety of financial assets, market indexes, commodities, stocks, cryptocurrencies, and so on. There are two types of options contracts: call options and put options. A call option bets on the price going up, while a put option bets on the price going down. As with other derivatives products, options contracts can be based on a wide variety of financial assets, market indexes, commodities, stocks, cryptocurrencies, and so on.